Hey guys, my name is Desmond Leong and welcome back to another exclusive podcast from IronFX. This time, we're going to be talking about one of the most popular technical analysis methods, which are trend lines. We'll talk about some of the most popular questions that revolve around trend lines, which are mainly, which time frame is it best to use them on? And do you consider the wicks or do you not consider wicks when you are drawing them? How many touches is required for it to be considered a valid trend line? Is it 2, is it 3, is it 4? What markets can you use trend lines on? And finally, how exactly do you trade them? So anyway, before we begin tackling those questions, I think one of the most important thing that we need to define is what exactly is a trend line. So for those of you guys who are listening in on this podcast, right, there are trend lines. Just imagine you drawing any straight line on a chart, right? It's not necessarily a horizontal line, or vertical lines, but instead lines that are sloping up and lines that are sloping down. So those are called trend lines. All right, it is used very widely in trading. Right, a lot of people use them in conjunction with channels. For example, channels are something like two parallel trend lines. Right. Some people use it in conjunction with moving averages to determine the momentum of a market. Some people use it in conjunction with like the Ichimoku cloud, right, to also determine the momentum of the market. It's used mainly, right, to determine where price might bounce from, every time it approaches the trend line. And if it breaks the trend line, it's good to usually use to suggest a change in the momentum. All right, so now that we roughly have an idea of what trend line is, right, how people tend to use it is they tend to connect the lows, right, the low points of, or rather some people call it the throws, right, of prices, as it's going up or as it's going down, right? But some of the common questions is, when we're using trend lines, what time frame is it best to use them on, right? There's the 1 minute time frame. There's a 5 minute, 30 minutes, 1 hour, 4 hours, 1 day, 1 week, 1 month, right? It can go on and on, right? The answer to this rather is actually revolves around the reliability of the different time frames. So when it comes to the smaller time frames, such as the 1 minute, the 5 minutes, the 15, and even maybe the 30 minutes, right? There's a lot more noise during in those time frames, meaning that any technical analysis approach that you use, right, will be less effective, right? Because there are naturally less people that look at the 1 minute time frame compared to the 1 hour time frame, right? And because of that, when naturally the lower time frames, I would tend to try to avoid the lower time frames, right? So a good approach to actually to tackle this question on which time frames is it best to use them on is actually to take in technical analysis we call it a top-down approach, right? Meaning that we go from a higher time frame down to a lower time frame. All right, that means we can go from the 1 day time frame, go down to the 4 hour time frame, then go down to the 1 hour time frame, drawing trend lines on all of them. Now it's important to consider this thing called time frame sensitivity. Right. Meaning, and this is not only for trend lines, this can be used for any technical analysis that you use, meaning that you don't want to overstretch yourself or go crazy, with analyzing every single time frame when you are doing technical analysis, because that's just going to lead you to paralysis, this thing called analysis paralysis, right? So for example, if you're trading the 5 minute time frame, you should not need to care what happens on the 1 day time frame. You should not need to care what happens on the 1 week time frame, because the distance between a 5 minute bar and a 1 day bar is just way too far, right? There's that in terms of the time frame sensitivity, is very, very weak. But what you see on the 1 day time frame and a 4 hour time frame, very closely linked. What you see on a 4 hour time frame and a 1 hour time frame is very closely linked, right? So the answer to this question is more of start from a higher time frame. Usually, if you are day trader, right, you can consider the 4 hour and 1 hour time frame, right? If you are a swing trader, meaning that you take trades beyond a that lasts longer than a day, can consider the 1 day time frame followed by the 4-hour time frame. And if you're a long-term trader, you can consider the 1 week time frame and then zoom in on the 1 hour time frame, right? I would try to avoid trend lines on the smaller time frames like the 1 minute and 5 minutes because they tend to be a lot less reliable. Moving on, the next question we're going to look at is, do we consider the wicks or do we not consider the wicks when we're drawing trend lines? The short answer to that question is yes, we do. And it's because it reduces the subjectivity when drawing trend lines. Because you see, when you use the wicks, you are using the same high and the same low point universally across all the other time frames. For example, what I mean by that is a 1 hour candlestick is made up of 4 different closing prices if you break it down into the 15-minute candlesticks. And if you break it down into the 5-minute candlesticks, it is made up of 12 different closing prices. So if you actually try to use the closing prices, it will leave too much to subjectivity. However, if we use the lowest price or highest price as captured by the wicks during that time frame, it will always be the same price, no matter which time frame you look at. And that is why we use the wicks when we are drawing trend lines. One other common question we have is how many touches is required for it to be considered a valid trend line. So when it comes to drawing trend line, we need to hold ourselves to a very high standard, a very high requirement. Otherwise, every single line could practically be a trend line, and that would lead us to take a lot of wrong trades, right? So when it comes to deciding how many points is required, 2 is what I call a coincidence. Three touches on the trend line is the minimum number required for it to be considered a valid trend line. So if you look at your charts, right? If you look at your charts and you start drawing trend lines, if you notice that, we've got 1 point and 2 point that lines up nicely, right? That is still a pending trend line. It's not confirmed yet. Only when there's a third bounce. And usually, you'll be even nicer if you catches it right on the extreme end of the wick, right? Then you can consider it as a valid trend line. And so I usually get a question, what markets can you use trend lines on? And the answer to this is that while you can use it on practically any market, the best markets that they tend to work on are markets where there are is a lot more liquid, there's a lot more liquidity, and there's a lot less volatility. What I mean by volatility is not that it doesn't go up or go down, but rather when you look at the candlesticks, you want to see less wicks, right? If you just try to pull up one of those emerging markets like $CNH or $SGD, right, $ZAR, right, you will notice that there are a lot of wicks when you're looking at the candlesticks, right? That means the candlesticks are not clean, right? There's a lot of shadows. There's a body, but there's also a pretty long shadow from almost every single bar that you see. Now the problem with that is that especially when you're using wicks to draw candlesticks, that leads you to have a lot of that leads you to having more inaccurate candlesticks. More inaccurate trend lines, because you're trying to line up the wicks and with all these different wicks, you might firstly pick the wrong one. Secondly, right across different brokers, you got different price feeds. So some wicks are higher, some wicks are lower. So what looks like a trend line on one broker might not be a trend line on the other broker, right? And that also leads us to another point where it's sometimes better to look at to draw trend lines on markets where there's they usually operate through a central exchange. Meaning, if you look at for example, when you look at euro dollar, right, there's 100 different charts on 100 different from 100 different brokers on euro dollar. But you look at Tesla, right, everything is traded through Nasdaq, right? So you know that the price points you're looking at is universally the same, right, across all brokers, or it's roughly the same across all brokers. Right, so that's one thing that you should consider, right? So things like looking at some futures, looking at gold, oil, right? Looking at the popular stocks out there, right? In the even the indices like S&P, Hang Seng Index, Nikkei, right? They tend to work better with trend lines, because remember, with trend lines, it's always a question of subjectivity, right? And with this what's the word for it? With these markets, right? Because they, those at least those who work through a centralized exchange, there's a lot less subjectivity. There's a lot less room for misinterpretation of the prices. And that leads us to our last question on, finally, how do you trade these trend lines? Right, so there are two main ways to trade trend lines. There's the trend line bounce or the trend line reversal, where imagine if you have an ascending trend line, a trend line that slopes upwards. Right, there are two ways to play this. One is when price touches a valid trend line, you can play the bounce. So each time it touches it, you play the bounce. Each time it touches it, you play the bounce. Right, and then there's the descending trend line, where you can imagine there's a trend line that is descending, sloping downwards. Each time price touches the trend line, you go short, right? You play a reversal, it touches there, you play a reversal. So that's what I mean by playing the bounce and playing the reversals. So that is one way you can play trend lines. And the other way is playing the breakouts. So same thing, imagine you have an ascending trend line, a trend line that slopes upwards. Right, so each time price touches it, the bounce might occur, right? But you can also play the breakout. So when price closes, right, price closes below the trend line, right, that's an indication that price might be breaking out. Right, so in these kind of cases, right, if it's a ascending trend line, a breakout will mean that you go short, right? You start selling because you expect prices to have we call it a bearish breakout, and prices to drop strongly from there. Usually, this works better when you combine it with multiple different studies. Like, so for example, if it not only does it break out from do a bearish breakout from the ascending trend line, if it also breaks the Ichimoku cloud, right? If it also breaks a horizontal support level, right? That is additional indications, right, that the breakout is a successful breakout. You ultimately want to look at multiple different factors that line up together to confirm the move, right? Is there bearish divergence, on the stochastic, bearish divergence on the RSI? Does it break out from the Ichimoku cloud? Is there a channel that it breaks out from, right? So these are all different things to consider. Even the breakout that occurs, look at the price action, is it three black crows, right? Because which is a very strong price action pattern to suggest a nice reversal, or does it form something like a doji, right, which has a weaker strength, more indecision, right? So when it comes to these kind of trading strategies, right, usually they don't work that well in isolation. They work better when they're together, right? They work better when they are together. You combine multiple different studies together to get a clearer, more high probability setups. So once again, long answer to a short question on how you trade trend lines. You can play the bounce, you can play the breakouts, you can play the reversals, and you can also play the breakouts. But the one key thing to keep in mind is that try to combine multiple studies together to give yourself the highest probability of a successful trade. Now that's it from me, guys. I hope you found this exclusive podcast from IronFX helpful, especially in understanding how to use trend lines to trade more effectively. And if I may remind everyone, to please subscribe so you don't miss out on our other podcasts where, we do our best to guide you and teach you on how to be a profitable trader.